The Indian government is considering the implementation of the Direct Tax Code (DTC) to replace the existing Income Tax Act of 1961. The DTC aims to modernize India's taxation framework, simplify compliance, and align tax laws with global best practices. Key highlights and implications include: key features of the DTC. 1. Simplified taxation. Standardized and simplified tax slabs and rates. Removal of outdated concepts like previous year and assessment year, only financial year will be used. Integration of tax laws like dividend distribution tax and wealth tax into a single framework. 2. Capital gains and exemptions. Uniform treatment of short and long-term capital gains. Simplification or removal of many tax exemptions and deductions for easier compliance. 3. Residency Rules. Updated criteria for resident and non-resident taxpayers, especially targeting economic connections to India for NRIs. 4. Corporate taxation. Unified corporate tax rates for domestic and foreign companies to encourage investment. Adjustments to transfer pricing and general anti-avoidance rules, GAR, to prevent tax evasion. 5. Digital economy focus. Specific provisions to tax digital transactions and cross-border digital services effectively. Implications of the DTC. 1. For individuals. Easier tax filing due to standardized deductions and streamlined rules. Potential increase in tax for high-income earners under progressive taxation policies. 2. For corporations. Enhanced clarity and reduced litigation. Potential for increased foreign direct investment due to uniform tax rates. 3. For the economy. Broader taxpayer base as exemptions are reduced, encouraging higher voluntary compliance. Increased revenue collection through updated withholding tax and anti-avoidance measures. 4. Challenges. Initial transition complexities for taxpayers and administrators. Potential economic impact on investment behavior due to changes in capital gains taxation. The DTC is expected to make India's tax system more transparent, equitable, and competitive. However, its implementation will require careful management to address stakeholder concerns and ensure a smooth transition. The reforms may be officially presented in the Union Budget 2025. Present status of the Direct Tax Code (DTC). The Indian government is actively preparing to introduce the Direct Tax Code (DTC), which is set to replace the Income Tax Act of 1961. The DTC is expected to be a centerpiece in the Union Budget 2025. A series of subcommittees under the Central Board of Direct Taxes (CBDT) have been reviewing existing tax structures and gathering suggestions from stakeholders. Over 6,500 recommendations have been received to refine tax laws, reduce litigation, and improve compliance. Future prospects. 1. Simplification of taxation. A more streamlined and transparent tax system is expected, with simplified language and reduced ambiguities. Introduction of a predictable standard deduction system and uniform tax treatment across various income categories. 2. Impact on foreign investment. Revised corporate tax rates and anti-avoidance measures will likely make India more attractive for foreign investors. 3. Digital taxation. Provisions will address the challenges posed by the digital economy, enhancing the government's ability to tax online and cross-border transactions. Benefits for common people. 1. Easier compliance. Simplified filing procedures and reduced paperwork will make tax compliance easier, especially for salaried individuals and small businesses. Unified tax slabs could lead to more clarity and reduced errors during tax filing. 2. Potential for lower tax burden. Broader tax slabs and the elimination of superfluous exemptions may result in a more equitable distribution of tax liabilities. 3. Encouragement for savings and investments. Restructuring of Section 80C and similar provisions could incentivize saving while aligning deductions with economic growth goals. Possible challenges and concerns. 1. Initial adjustment period. Taxpayers and professionals may face a steep learning curve during the transition. Administrative changes could temporarily increase the burden on tax authorities. 2. Impact on high-income groups. Progressive taxation might increase the tax burden on wealthier individuals, potentially affecting their investment decisions. 3. Reduced exemptions. Removal or consolidation of existing exemptions, example, housing and insurance, may lead to higher taxes for some, especially those who heavily rely on exemptions to lower their tax liabilities. Conclusion. The DTC is poised to modernize India's taxation system, making it simpler and more transparent. While the reform holds promise for broadening the taxpayer base and increasing compliance, careful implementation will be key to addressing potential challenges and maximizing its benefits for common citizens and the economy. Additional key points about the Direct Tax Code (DTC). 1. Historical background. The Direct Tax Code was first conceptualized in 2009 during the tenure of Finance Minister Pranab Mukherjee under the UPA government. The objective was to simplify the tax laws, increase transparency, and make compliance easier. However, the bill faced delays and was never implemented due to various political and administrative challenges. 2 key goals of the DTC. Modernization of tax laws, bringing outdated laws from 1961 in line with contemporary economic realities and global practices. Broader tax base, reducing exemptions to ensure more people and entities fall under the tax net. Ease of compliance, simplified tax laws to reduce disputes and litigation. Transparency and predictability, clear tax slabs and rules for individual and corporate taxpayers. 3. Integration with Digital India. The DTC incorporates provisions for taxing digital transactions and the digital economy, an area often under-regulated in traditional tax laws. 4. Focus on anti-avoidance. Strengthened general anti-avoidance rules, GAR, to curb tax evasion strategies, especially those employed by multinational corporations through profit shifting and complex financial arrangements. 5. Tax dispute reduction. Streamlined rules and reduced ambiguities aim to minimize disputes, which have historically clogged India's judicial and tax systems. 6. Corporate and capital gains taxes. The DTC proposes a more uniform treatment of corporate and capital gains taxes, addressing double taxation issues and promoting equity investments. 7. Environmental and ESG alignment. It is expected that certain tax incentives may align with environmental, social, and governance (ESG) goals to encourage sustainable development. Challenges in implementation. Times overhauling an entrenched system like the Income Tax Act of 1961 poses significant administrative challenges. Times resistance from stakeholders accustomed to existing exemptions and tax structures. Times transitionary hurdles for businesses and individuals adapting to new rules. Future direction. The government, led by the Ministry of Finance and the CBDT, is working to present a refined version of the DTC in the Union Budget 2025. This effort seeks to address modern economic challenges while fostering greater compliance and fairness in taxation. These updates aim to revolutionize India's tax system and position it for sustainable economic growth. The existing Income Tax Act of 1961 in India has served for decades but has several drawbacks that necessitate reform. Here are the main issues. 1. Complexity and ambiguity. Times the Act is highly complex, with over 298 sections, numerous subsections, and multiple schedules. This makes compliance challenging for taxpayers, especially individuals and small businesses. Times terms like assessment year, previous year, and intricate definitions of income categories add unnecessary confusion. 2. High compliance costs. Times taxpayers often need professional help to understand and file taxes, increasing compliance costs. Times the detailed and lengthy process discourages voluntary compliance. 3. Narrow tax base. Times only about 1% of India's population pays income tax, highlighting the limited reach of the current tax system. Times a significant reliance on indirect taxes burdens lower-income groups disproportionately. 4. Inefficiency in dispute resolution. Times tax litigation is a persistent issue, with many cases pending in courts. The ambiguous language and loopholes often lead to disputes between taxpayers and authorities. 5. Outdated provisions. Times many sections of the Act are no longer relevant to modern economic realities, such as provisions related to wealth tax and certain exemptions. Times the Act struggles to address emerging areas like the digital economy and cross-border digital services effectively. 6. Inconsistent corporate tax regime. Times the tax rates and rules for domestic and foreign companies lack uniformity, creating complications for multinational corporations. Times transfer pricing regulations and other anti-avoidance measures are not robust enough to curb tax evasion effectively. 7. Over-reliance on exemptions and deductions. Times a plethora of exemptions and deductions leads to complexities and provides opportunities for tax evasion. Times it also limits revenue collection and creates inequality in taxation. 8. Progressive taxation challenges. Times the current structure of progressive taxation often burdens the middle-income group more than the high-income group due to inadequate enforcement and loopholes for wealthier individuals. 9. Limited adaptability to technological changes. Times the system has not fully integrated with modern technology for efficient tax collection and assessment. Times digital transactions and e-commerce are not adequately taxed under the current framework. Conclusion. These issues underscore the need for a streamlined and modernized tax framework, which the proposed Direct Tax Code (DTC) seeks to address. By simplifying the tax regime, broadening the taxpayer base, and aligning laws with contemporary economic trends, the DTC could overcome these drawbacks. The Direct Tax Code (DTC) in India is expected to be introduced as part of the Union Budget 2025. The government is aiming for its implementation to overhaul the outdated Income Tax Act of 1961. The code seeks to simplify tax laws, reduce litigation, and modernize the framework to better reflect India's current economic environment. Several committees under the Central Board of Direct Taxes (CBDT) are actively working on refining proposals based on extensive stakeholder feedback. Comparison with global tax systems. Globally, taxation systems vary based on governance, economic priorities, and social welfare needs. Here's a brief comparison. 1. United States operates a progressive tax system with 7 individual income tax brackets. O. Corporate tax is levied at a flat rate of 21%. O. Allows numerous deductions and credits to encourage investments and welfare. 2. United Kingdom. O. Progressive personal income tax rates, ranging from 20% to 45%. O. Corporate tax rate currently stands at 25%. O. Has introduced measures like digital service taxes to regulate cross-border digital transactions. 3. Singapore. O. Low personal income tax rates, capped at 22%. O. Corporate tax is a flat 17%, attracting global businesses. O. The tax system is designed for simplicity and efficiency, with few exemptions and deductions. 4. Australia. O. Progressive personal income tax rates, up to 45%. O. Corporate tax rates are differentiated, 30% for large businesses and 25% for smaller entities. O. Focus on fair compliance and significant social welfare funding through taxes. India's proposed DTC aims to align with global best practices by reducing complexities, expanding the taxpayer base, and addressing digital taxation challenges. If implemented effectively, it could make India more competitive and investor-friendly while simplifying compliance for citizens.